On today's show, it's all about taxes and tax harvesting. So grab yourself a brew and we'll start right now. As the year comes to an end, one thing on everyone's mind, of course, is taxes. How much am I going to have to pay for my investments this year? To understand the answer to that, we first have to look at what are the taxable events that we're going to have to take into consideration when we're figuring out what type of taxes we're looking at paying in this calendar year. So these events include things such as capital gains, business income, dividends, interest, airdrops, and of course rewards. These will all come into play as we're figuring out our tax loss harvesting strategy, or if we even need to do any form of tax loss harvesting this year. Let's first begin by looking at business income. When you're understanding what business income is, we're not talking about owning a business. Sometimes when you're investing, your behavior can behave more like a business. And in those cases, it's considered business income instead of capital gains or capital losses. So for example, if you're doing a lot of frequent trading, such as a day trader, well, that is business income behavior. And the CRA may look on that as a business income opposed to a capital loss. If you are buying securities with an intention to flip them, so making some fast profits, the CRA can also look at that as being a business income behavior. Also, penny stocks. Usually if you're buying a lot of penny stocks and then selling them, that's a business income behavior because you're not buying penny stocks for a long-term investment for the most part. Interestingly enough, if you're buying and selling more frequently with blue chips stocks, so for example, banks, stocks with half decent dividends, the CRA tends to not look on them as judgmental when it comes to is it a business income, because people are not normally flipping blue chip stocks. So there's one more advantage to having some blue chip stocks into your portfolio. So business income is taxed at 100%. That's why it's really important to understand whether or not a particular trade that you're making is business income or capital gains, because the tax ramifications are completely different. So business losses, they can be claimed against all income sources. So that's one of the big differences between a business loss and a capital loss. Let's look at capital gains and losses. So a capital gain is taxed at 50%. Meaning that if you earned $100, $50 of that is taxable. A capital loss can only be applied to a capital gain. So if you have capital losses, you can't apply that against a business gain, for example. It can only be applied against a capital gain. No capital loss if you repurchase the stock within 30 days. This is referred to as a superficial loss. So if you sell a stock at a loss, but then buy it back a day later when the price has dropped, that is not a capital loss. That is a superficial loss, and you cannot use that. So for example, if you have a stock and you decide to sell it at a loss to basically generate a capital loss, but then you buy back in within 30 days, it is not going to count. You will not be able to use that stock at all when it comes to balancing against your capital gains. So this is something to definitely keep in mind. Now with dividends, Canadian dividends are taxed less than income, so they're not taxed at 100%. There's something called the Canadian Dividend Tax Credit. The amount of tax that you would pay on regular income, let's say you were paying 50% on regular income, with a Canadian dividend, you're looking at about 30% that you're going to be paying when all is said and done. Definitely it's a great thing for Canadian dividends. Of course, if you put your Canadian dividends in a registered account like your TFSA or your RRSP, then you don't have to worry about these taxes at all. So definitely put those in a registered account. So when it comes to foreign dividends, they are 100% taxable. There is a foreign tax credit for the withholding fees. So for example, with an American stock, any dividends you receive, they would withhold 15% of them. Through the foreign tax credit, you could claim that 15% against your taxes. If you were to put these in your RRSP, then you don't have to worry about those dividends. Unfortunately, with the TFSA, you do have to, because they still are going to hold a withholding tax, because even though the TFSA in Canada, we see that as being a registered account, the US does not see it as being registered. Thus, it doesn't provide that same tax shelter. So interest, airdrops, and reward. When it comes to interest is treated as 100% income. Simple as that. So if you have Bitcoin, for example, over on BlockFi, that interest that you're receiving, that's 100% taxable. So airdrops and staking rewards, they're treated as $0 crypto purchases when applied in calculating your average cost base. Holy banana bread, what is the ACB? We're going to get right into that here in just a moment. Let's just talk about a few harvesting basics first. The first of our basics is that we basically are using our capital losses to negate capital gain taxes. The other aspect is that we're using business income losses to negate income on any gains. And that can be fantastic. So sometimes a business income loss can actually be beneficial. So there's also some important time considerations when it comes to tax loss harvesting. So the first of these is a capital loss occurs on the settlement date, not the trade date. So if you're trying to save yourself some taxes by tax loss harvesting on December 31st, it's not going to work on this year's taxes. It needs to be on or before December 31st, and that's the settlement date. So keep in mind, it takes a couple of days to settle. I would definitely recommend doing any kind of tax loss harvesting before the 28th of December, just to be on the safe side, to make sure your settlement happens before December 31st. Or on December 31st. So that's a huge factor. So RRSPs, they can be, now they're a little different. They can be contributed on or before March 1st. So if you do run into a situation where you miss the deadline for tax loss harvesting, the RRSP does provide some additional options to try to help with your taxes. So now comes the average cost base, the ACB. This is where, yes, there will be some math. But first of all, let me tell you very basically what this is. So a loss or gain is first calculated using the difference between the sell price and the ACB. So what you're using is basically you're using an average cost on your stocks, and you're calculating any sale, you're calculating the difference between those prices. Now you can use software to calculate it, or you can do it manually. It's actually quite easy, and I'm going to show you how to do that. So let's look at calculating your ACB. So first thing you will do is you will sum up all the money that you spent on a specific stock, and then you can divide that sum by the total number of shares, and that will give you an average cost per share, an ACB. Sometimes it's also called an adjusted cost base as well. So you may hear adjusted or average. Both of them they're exactly the same thing. So let's give you an example here, because sometimes just telling you how it works doesn't make it as clear as it should be. So in this example, we're going to buy 5 shares of whatever company, it doesn't matter. Let's say we bought 5 shares at $5, and then a little bit later we bought 5 shares at $10. So the ACB would be the sum. So in this case, we bought 5 shares at $5, so 5 times 5 is 25, plus 5 shares at $10, so 5 times 10 is $50. 50 plus 25 is $75. That's our sum. We then have to divide that by the total shares. Well, both times we bought 5 shares, so we have 10 total shares. So in this case, our average cost base or adjusted cost base is $7.50. If I sold 5 of those, let's say the stock went down and I'm trying to create a tax loss harvesting situation, if it went down to $3 and I sold 5 of those shares at $3, well, my loss would be $5. So I sold 5 at $3, so 15 minus the average cost base, and that's per share. So we had 5 of them. So that's going to be 7.5 times 5, which is $37.5. So 15 minus 37.5 would produce a $22.50 loss. So that would be our loss that we could actually use to apply against a capital gain. So that is our capital loss. Or if this happened to be a business loss, that would be our business loss. So it's pretty simple to use. You can build this up nice and easily into a spreadsheet. There's also, of course, as I mentioned, there is software that will do this for you. Unfortunately, some software especially if you do it in your bank. A lot of times your bank will give you the tax forms and information at the end of the year. They don't sort of keep a running cost on it. So you have to be kind of paying attention to what you're doing through the year, or just downloading all your transactions and just manually try to get them all together before the end of the year so that you know if you need to do any tax loss harvesting. In practical, you want to calculate using ACB losses and gains per stock. So that is an important piece of information, is that the ACB is completely different for every single stock. You need to make the calculations for any stocks that have produced a gain or a loss. So if you have a lot of gains, you can then use this tax loss harvesting strategically to offset some of those gains. And that's the whole general idea of tax loss harvesting, is you're basically creating losses to offset gains. And in some cases, like this particular year in 2021, there's a lot of red in the market, so there's a lot of opportunity to create some losses. Now you may be of the type who doesn't like to sell at a loss, but sometimes it makes sense, because if your capital gain is pushing you in a higher tax bracket, sometimes you may just want to do some tax loss harvesting to push you down into the tax bracket that's a little bit lower, that has significantly lower taxes. Because the whole object is to pay less taxes, keep a little bit more of your money in your pocket. And that's what tax loss harvesting is all about. So a few final considerations when dealing with tax loss harvesting. The first is that you can carry forward your capital losses indefinitely. So if you have losses, but you don't have any gains, well, no fret. If you have gains next year, you can use the net, they call it a net capital loss. That's the amount that moves forward. So your net capital loss is basically any capital losses that you haven't applied. So you can move them forward indefinitely until you do have some gains. Hopefully that won't be the case, because I'm hoping that you guys are making more gains than losses for the most part. You can also apply a capital loss to one of the last 3 years. So if you have some big losses this year, but let's say last year you made bank, or the last couple of years you made bank, you can retroactively apply this backwards. So that will just basically generates giant credit going forward under this one, and you can end up with a big refund depending on how you play that. So apply a capital loss to one of the last 3 years. You can definitely do that. And of course, if you do not harvest enough, you have a last chance via your RRSP, so you can contribute to that up to March 1st. So one of the things you definitely want to do is, if December 31st has rolled around and you're like, oh, you know what? I miscalculated something. I've still got a little bit, I'm going to be paying a bit more taxes than I want to. You can certainly offset that by contributing to your RRSP. So those are the things you need to keep in mind when dealing with tax loss harvesting. So if you like this content, definitely click the like button. If you want to see more like it, click on subscribe, and then ring the bell to know every time I upload a video. Until next time, folks, I will bid you a fond adieu.